Welcome to Prescribing Prosperity with your hosts, John and Alex Soutsos from MedWealth Financial Services, operating through IPC Securities Corporation. In this podcast, we provide unique insights into wealth management, the psychology of financial decisions, and help listeners place the capital markets into perspective. Our aim is to help physicians, business owners, and other medical professionals to live their dream. Life is to live and enjoy, so we'll also cover health and lifestyle-related topics such as food, dining, travel, and unique experiences. Learn how global trends shape our investment strategy as we help you assemble your roadmap to prosperity.
And welcome to the Prescribing Prosperity podcast with your host, John and Alex Soutsos. Guys, good to be with you again.
Thank you, Bill. Good to see you again.
Good to see you as well. For those who are new to the podcast or missed the last podcast, let me just bring you up to quick speed here. Last podcast episode, we began looking at some of the history of the stock market and the markets in general. We covered the stagflation of the 70s, Black Monday and the 87 market crash. We talked about the savings and loan crisis, and then finally the Gulf War. And for those of you who are wondering, why in the world are we having a history class? Well, if you've been asleep for about 10 years and you just woke up, you might not have noticed that we are in a tremendously volatile time for the market. So it does make sense in that context, Alex and John, that you're talking about this. It's good to remember the markets in many ways have been there and seen that over and over and over again. We got up to the 90s, Alex. Where do you want to pick this conversation up?
Yeah, thanks, Bill. As you mentioned, we just wrapped up in the early 1990s with the Gulf War, which occurred at the end of 1990 and into 1991. And at the time that the war broke out, many citizens around the world were concerned about how the subsequent events were going to unfold and what impact it would have on their daily lives. And fast forward to today, and many people are finding themselves in a similar situation. Since our last episode, the attacks on Israel have led the nation to declare war on Hamas. The level of civilian casualties is heartbreaking, and we both hope for a peaceful resolution as soon as possible, and we extend our sympathies to all those who have lost loved ones in this conflict. And it's a difficult subject to transition away from or try and pull back into a financial context when we're talking about the loss of life. But we're going to try and keep things informative and try and provide some context as to how this might affect people here at home, here in North America, I should say. So I'm going to turn it over to my dad and just get his perspective. Dad, how do you foresee the Israel-Hamas war impacting the financial markets in the coming weeks and the coming months, perhaps?
Well, thanks, Alexander. I wish I could foresee, but I can't. I can only give an educated opinion. At the present time, the markets appear to be taking the events in Israel within context. The only impactful segment that has shown any changes has been the price of oil spiking up on the Monday from a week ago. Other than oil prices, the market really is doing what it's been doing based on its typical pattern at this time of year. We're in the early stages of the third quarter earnings reports. We are in a options expiry week, which typically causes stocks that have run up in the preceding month to come back to earth, and stocks that have been oversold in the preceding month to come back to closer to fair value. So at this point in time, the impacts of the attacks on Israel have not been material on the capital markets. However, the potential is there for something far greater if the scope of this war goes beyond Israel's borders. So we are closely monitoring our portfolio and how it's being impacted potentially, and we'll be prepared to make modifications should those be required.
Right. I think that makes sense. And just to give everybody some perspective, historically, when we look back at strife and war across the world and how it impacts the markets, specifically the S&P 500, Historically, we've seen an average drop of about 1.1% in the first trading day following the outbreak of war. And then the average total drop of about 4.7%. And usually it takes about 6 weeks for the index to recover on average. And so outside of a few select areas, that being defense primarily, as you can imagine, war generally leads to an increase in manufacture of weaponry, which some of the defense industry tends to benefit from the outbreak of war. And then when it comes to political strife in the Middle East, that can also result in impacts to oil prices, as you mentioned. So those are the two primary areas that are generally affected. And what we've seen historically is it's been relatively short-lived in terms of the impacts to the market over here in North America.
Just to supplement you quickly, Alexander, sorry to interrupt. Common discussion that happens between us and our clients is when discussing risk in the financial markets is, well, what about interest rates? And what about this law that's about to change? What about the war in Russia, Ukraine? What about this? What about that? And something that's important for investors to understand and internalize is the risks that are plainly visible are not the risks that the market is going to be impacted by. It's always the risk of the unknown. It's the risk of something coming out of nowhere, like the attacks on Israel coming out of nowhere. Those are the real risks to the market. So those risks can never be predicted. And so you always at all times have to keep that in mind as an investor. The potential for a rapid pullback is always there due to unforeseen circumstances and not from risks that you plainly see in front of you or that are reported on the nightly news.
Right. And this, for everyone at home, is known as systemic risk. And systemic risk cannot be diversified away. Systemic risk is something that is ever present in the market and affects all companies. So that being said, we're going to try and pull things back into our history lesson and look back on past financial market crises. So we are now post 1991. We are transitioning over to 1994, the end of 1994. And we're going to discuss the Tequila Crisis, which occurred in Mexico. And so, Dad, tell us a little bit about what happened and what led to this event that would eventually have impacts not only in the United States and the market there, but then across the world.
So the Tequila Crisis is a currency crisis in its essence. It had to do with an over-leveraging of the Mexican economy and an artificial pegging of currency relative to the US dollar. This is common back in the 80s and 90s as many emerging markets around the world were trying to increase their trade exports with the United States and other developed economies. And when you create a peg to any currency, inevitably you need to have a vast amount of foreign currency reserves to maintain that peg. And if you don't, and you go out of balance in your domestic fiscal and monetary policies, things can unravel very rapidly. Ironically, it is the United States that usually is the trigger for a lot of these currency crises, in that the central bank is running monetary policy for the United States, but it is a de facto central banker for the rest of the world. And every time the U.S. central bank raises interest rates, they are creating a problem for countries who are trying to maintain a fixed currency exchange with the U.S. dollar. This is essentially what happened in 1994. The Central Bank of the United States increased interest rates from early 1994 from 3%, effectively doubling it to 6% within a period of about 1 year from early February 94 to early February 95. During this period of rising interest rates, the stresses on Mexico to maintain their currency peg continued to rise, and eventually it collapsed, and they were unable to sustain it. And so you had a dramatic drop in the value of the peso. Some bonds were not repaid. It was a big scandal. Now, as far as how it affected the stock market for investors in North America, the impact was seen primarily in the bond market. So the bond market in 1994 declined by, I think, about 20%. I'm going from memory right now. So the impact on the bond market was quite significant. Now, the impact on the stock market during 1994 happened early on when the interest rates began to go up. There was a pullback of approximately 11% on the S&P 500, but it started to rebound relatively quickly over a span of a few months from the spring to the summer. And then it pulled back a little bit again toward the end of the year before resuming its uptrend. So it didn't clear its February 1994 high. It cleared that and started going higher in March of 1995. So it was relatively short-lived sideways meandering for the stock market. In any year in the stock market, you're going to get about a 10% market correction from which the market usually comes back from. So yes, there was an impact initially, but it came back relatively quickly. The bond market, by contrast, was much worse off.
Okay. And so I think one thing that's important to clarify is why exactly the Mexican peso fell so dramatically. And so the typical reaction is when a currency like the United States, when the interest rate is raised relatively quickly, money flows into that currency because there's a higher rate of return for government denominated fixed income instruments. And so as a result, there was a greater demand for U.S. securities relative to the Mexican peso, and therefore or Mexican securities, I should say, and therefore the peso slid. And the central bank in Mexico allowed the peso to devalue in the neighborhood of 13 to 15% at the end of 1994, while at the same time raising interest rates by 32% on short-term rates. And so what ended up happening was after they made this move, they then allowed the peso to float freely again. Roughly 2 days later,
I like Pexico. There's a new term for the Mexican peso, the Pexico.
Sure, Texaco and Pepsi just bought the Mexican peso, and they're going to combine. So anyway, so the resulting free floating of the currency caused it to drop nearly 50% over the ensuing months, and the devaluation made it difficult to repay significant portions of U.S. denominated debt, U.S. dollar denominated debt that were held by both banks and other companies, and so it created a massive economic contraction within Mexico at the time.
And this is the great thing about controlling your own currency. So when you are a country that controls its own currency, you have the ability to adjust its exchange rate with other global currencies. And by adjusting that, you can bring equilibrium back to your economy. It takes a period to adjust, but nonetheless, you come back relatively quickly. Whereas when you don't have that capacity, which a good example of that is in the European Union, where you have a bunch of countries that are tied to one currency, yet the local realities of each country are very different. You don't have the ease with which to do that. And so that's a great thing about free-floating currencies, but they have to float freely from the outset. And trying to maintain currency pegs is very, very difficult. And really, this all began a series of currency devaluations and financial crises throughout the 1990s, going from the Mexican peso devaluation leading into the Asian financial crisis. And Alexander, do you want to give some color to that before I continue?
Yeah, so I mean, you can, I'll throw it back to you shortly here, but obviously, as you mentioned, whenever you're trying to have a foot in both camps, where you're trying to have a pegged currency and a free-floating currency at the same time, as the old saying goes, you can't suck and blow simultaneously. So you end up creating great difficulty within your financial system. And so, as you said, this eventually ended up leading to the 1997 Asian financial crisis, which went by many different names: the Asian contagion, the Thai baht devaluation, many of which are all under the same umbrella, in that there was a significant destabilization of the Thai baht, which was the currency in Thailand, and then also in a couple of other Asian countries. So why don't you pick it up, Dad, and tell us a little bit about what happened.
So let's get a little bit of background. As we are all aware, the Japanese economic miracle took place beginning in the early 60s as they became an export powerhouse, principally to the United States. And this economic miracle of a country's economy that was very far behind the developed world was what the Asian countries were trying to emulate in the late 80s and early 1990s. So Thailand, the Philippines, Malaysia, and South Korea were all trying to repeat that miracle economic recovery that Japan did in the 60s and 70s and into the 1980s. But in order to do that, they had to create some type of stable platform with which foreign economies could trade with, and they needed a reliable currency. So once again, they pegged their currencies to the US dollar at fixed exchange rates. But when you do that, you have to maintain foreign currency reserves. You have to be careful as to how much credit you offer internally within your domestic economy. The country itself, the government has to be careful with how much credit they take on. And inevitably, these countries essentially took on too much credit, privately, publicly, and eventually speculators saw the imbalance and began to attack those currencies. And the speculators would be people trading on the commodities exchange in foreign exchange currencies. And eventually the countries could not maintain those exchange rates. So they had to let go, allow devaluation to take place, even though they made some bold and brave statements throughout the period saying, we're going to maintain our exchange rate, we're going to defeat the speculators, et cetera, they were unable to do that. And so an adjustment took place, and those countries had to experience an economic downturn to reset their standard of living at lower levels, while the exchange rate created the environment to rebalance the economy. And the interesting thing is that that rebalancing did eventually take place. Those economies did recover dramatically over the course of the ensuing decade. And today they have become very strong countries in terms of their economic profiles. But that destabilization in the 1997-98 period bled into two other events along the same lines. The next one being Russia and long-term capital management. So the implications of the Asian financial crisis manifested in the financial markets in the month of October of 1997. Where the unraveling of the events overseas began to impact the North American markets in early October. And by the end of October, on October 27th, there was a washout event, a day where the market fell over 7%. So the peak to trough decline was just under 14% during the month of October of 1997. The market began to recover from that point into the end of 1994, but it didn't get past its prior peak until the following March of 1998, at which point the events started to affect other countries around the world. And with that, and not to mention a big hedge fund in the United States. So with that, I'm going to ask Alexander to jump in and provide some color on long-term capital management.
Right. So long-term capital management was a hedge fund that existed in the 1990s. Their peak years were from 1994 to 1998. And their main strategy was to find pairs of bonds and capitalize on differences in the spread between the bonds using a convergence strategy. And the fund itself was run by Ivy League graduates who had been on Wall Street for many years and had separated off to create their own hedge fund that was supposed to generate superior returns. So with that, I'll flip it back to you, Dad.
Okay, thank you. So this was a very sophisticated pool of money. The minimum entrance was $10 million. There was restrictions on how much you could take out. You had to be committed for a 3-year period. And when you were able to take out money, it was restricted in terms of the dollar amount. So clearly the kind of people who invested in this hedge fund were extremely successful professional athletes, wealthy people from other walks of life who could afford to park $10 million without a problem, not worry about it. And so this is all going very well. And in fact, during the Asian financial crisis, their strategy was very effective and they turned a nice profit for their investors. Unfortunately, what happened eventually in 1998, as the Asian financial crisis was playing itself out, we also had the nascent Russian Federation emerging from the Soviet Union, trying to right-size itself in terms of its economic circumstances. And having been the center of the Soviet Union empire previously to that, Russia was trying to maintain stability with its peripheral states by offering to trade with them extensively. Unfortunately, Russia did not have the hard currency it required to always pay for the exports from these countries, and it began having difficulty maintaining the value of the ruble. Now, long-term capital management did not factor in a Russian debt default, and when they tried to cover or to provide some cover for their exposure, and they were seeking to buy U.S. treasuries. Unfortunately for them, but fortunately for the United States, the U.S. government, for a brief point in its history, had actual fiscal sanity take over, and they were running a surplus. And the number of treasuries being issued by the government in the second half of the 1990s had begun to dwindle. So the limited supply created a quick decline in interest rates on treasuries, which was beneficial for the U.S. economy, but not very beneficial for others. So inevitably, Russia could not sustain its exchange rate any longer, and it defaulted on its debt in August of 1998. And that's when things really turned bad for the financial markets. Between August and October of 1998, the U.S. market, as measured by the S&P 500, fell nearly 23%. And I remember that specifically during that summer, the dramatic decline, and the biggest part of the decline occurred toward the end of August, in the final days of August. And that was very dramatic. I remember it specifically. A lot of clients were calling in trying to figure out what was going on. There was a lot of fear. And of course, we said the things that we always say, which is these events will unfold and the market will right-size itself in time. You have to be prudent and should take advantage of declines in market values to buy at lower prices. But nonetheless, it did instill a lot of fear over a period of 3 to 4 months. However, the recovery did begin in late October of that year, and that was the early stages of the dot-com bubble and how the market began to run up, I should say, dramatically during that period. At the same time, the U.S. Central Bank began cutting interest rates in late September through to the end of November. There's 3 interest rate cuts of 1/4 point each, 75 basis points altogether. And that provided the liquidity required by the financial market in order to allow the stock market to begin recovering. The fact that long-term capital was buying treasuries at the time also contributed to pushing down the interest rates. So that was a period that spawned the dot-com bubble. And we had a big run in the stock market until the end of the 1990s.
Well, before we get into the dot-com bubble, I think there's a couple of things that we still need to touch upon with the long-term capital management failure. The one thing is that eventually the strategy, because they started taking increasingly risky and aggressive bets by leveraging their portfolio, they ended up getting caught in a situation where they were in debt in the neighborhood of several $100 million. And so when the fund was basically illiquid, they were forced to, or the central bank decided to bail out long-term capital management. And it was a consortium of several of the investment banks on Wall Street who provided liquidity to bail out the institution. And while that in and of itself is significant, I think what's more significant and what perhaps provided a little bit of foreshadowing here was the central bank's willingness and the Wall Street's willingness to step in and bail out these financial institutions for taking excessive risks in the market. And what it did is it created a situation of moral hazard. And many people have probably heard that term bandied about in the media. But what moral hazard essentially is that it creates an opportunity, or it creates incentive for institutions to take on more risk with the comfort of knowing that if they do and it doesn't go well, they will be bailed out, as opposed to facing the free market consequences of having to fail. And so what ended up happening in 1998 became a foreshadowing of what would come in the 2007 through to 2009 financial crisis. But we'll park that for now.
I point out that as that event was unfolding, when the central bank came in, got involved in the bailout of long-term capital management, there is a very, how can I put it, a very dramatic weekend where the New York Fed put together the consortium of the Wall Street bankers and to create the bailout, along with the help of the U.S. Central Bank. The amount of debt was actually quite massive. I think it was just under $400 billion. And they ended up selling long-term capital management to the consortium. 90% of the long-term capital management was sold in exchange for that funding. And eventually, when they liquidated the assets over the period of the next ensuing 3 years or so, they did eventually pay that back. But you're absolutely correct that the moral hazard of allowing the central bank to get involved to protect private interests did set a bad example. Now, Warren Buffett actually did, on that weekend, offer to buy long-term capital management at a very discounted price, and they refused his offer and pursued the other strategy instead.
Yeah, I apologize. I said several hundred million before. It was several hundred billion with a B. And yes, he did offer to buy them out. I believe he offered them $250 million, if I'm not mistaken, in order to buy out their troubles. And obviously, as you said, they turned that down. But one thing to note, going back to the notion of foreshadowing, is one of the companies that was involved in the bailout was Lehman Brothers. They provided $100 million. And Lehman Brothers in the 08, 09 or 07 to 09 financial crisis was actually one of the ones who was allowed to fail. And Lehman Brothers was very surprised when they were not rewarded with the same courtesy that long-term capital management and others were afforded when they went belly up. But as I said, we'll get into more detail about that later. And for now, we'll stick with where we are, which is in the late 1990s and moving into the dot-com bubble. And just to try and tie together what we covered so far, Dad, I just want to run a quick thread through everything, and that's starting with the Mexican peso devaluation through to the Thai baht devaluation, and then through to the Russian economic crisis. Can you just quickly, in a couple of sentences, just tie together what the central bank response was to each one of those events?
So the U.S. coordinated with the IMF to provide bailout money to the Mexican government in 1994-95, and obviously within the IMF bailout comes a laundry list of conditions. But throughout the late 1990s, the major moves of the central bank of the U.S. Obviously, we discussed 1994, where they doubled interest rates from 3% to 6%. But then in 1995-96, they cut interest rates 3 times, 0.25% each time, which fueled the capital markets further. But it was a relatively stable time in the capital markets in 95-96. 1997, the interest rates were increased just a little bit, 0.25 point one time, March 1997, really unrelated to the Asian financial crisis. But it was the September to November 1998 period when you had long-term capital management and the Russian crisis unfolding. That's when the central bank really got involved and cut rates 3 times for a total of 0.75% to try and provide liquidity to the financial system.
Right.
So that was the Fed's actions. And in addition, I note that in the final months of 1999 and the second half of 1999, because conditions had improved, the central bank began raising rates again. Right.
Before we get to that rate raise, though, it's important to understand that how the rate cuts affected the market, and specifically the tech market. And as we've discussed many times with clients and prospective clients, when the market tries to value a specific company, what it does is it forecasts the free cash flow that the company is going to generate in the future, and discounts it back to the present in order to come up with a valuation for the company right now, today. The discount rate that they use is a combination of the cost of capital for the company, the cost of equity, and the cost of debt. So when the central bank raises or lowers the cost of debt, they are raising or lowering the discount rate, which affects the value of the cash flows, which are being discounted to the present. I know that's a fairly technical financial or mathematical definition, but it's important to understand because it impacts how growth companies are affected specifically. And as in the late 1990s, as we do have today, tech companies are the ones who are the most impacted by the changes and fluctuations in interest rates because most of their value is derived from cash flows that are going to occur in the future. We have an expectation that most of their value occurs several years from now, or in some cases, decades from now. And so discounting those cash flows back to the present means that they are more susceptible to changes in interest rates. So when interest rates are low, you're discounting by a smaller number, so the value goes higher. And when the interest rates are higher, you're discounting by a larger number, the value of the company drops. And so in the late 1990s, you had a run up on tech companies because of the low interest rates, the speculation over how we were going to move into more of an integrated, open information economy, which obviously we did eventually move into by way of the internet. And so a lot of companies who were associated with the internet or associated with the technology industry saw their valuations skyrocket over a very short period of time. And so with that, I'll turn it over to you, Dad, to talk about what ended up happening just before the interest rates got raised in the late 90s and how that affected the market.
So thanks for that explanation. And to bring it back to the person on the street throughout the 1990s, because of the fact that you had all these Asian economies trying to replicate the success of Japan, there was a large push by companies in the mutual fund industry to promote emerging markets mutual funds, saying this is the next big growth area of the world, you got to take advantage. So there was a lot of money put into emerging market funds in the 1990s. And as we explained already, the timing couldn't have been worse. So a lot of people got hurt with that. Then we had the run in the late 1990s with technology, and the narrative at the time was that it was investing in the new economy versus the old economy, and valuation metrics for old economy stocks had to be adjusted for new economy stocks, and profits didn't matter anymore. Only top line revenue growth was important, and this is the conversation that was being had in the last 2 years of the 1990s, and people lost their minds. Companies that had no material business were being valued in excess of companies that had been around for decades and had real profits. And so there was a dislocation between reality and perception. So Warren Buffett's Berkshire Hathaway stock, which is essentially a financial services holding company, its stock began to lose value in the late 1990s. And by in the final 2 years of the 1990s, its stock actually declined, underperformed the market, the S&P 500, by nearly 60%. It was down 48 while the market was up. I don't remember the exact numbers, but suffice to say,
up significantly.
It was a 60% difference, and the commentary you'd get in the financial arena was that, oh, well, Warren Buffett is old. He doesn't know what he's doing anymore. He's lost his touch, and he's an old economy investor. He's not a new economy investor, and so you can't invest with Warren Buffett any longer, and you got to go with tech stocks. But what unfolded was that you had the dramatic decline in the early 2000s in the tech market. The dot-com bubble burst. For a variety of reasons, not the least of which was a rising interest rate environment during that period.
Now, can I pause you for a second, Dad?
Sure. Yeah, go ahead. Just
one thing to mention. You had touched upon some of the astronomical valuations that were occurring. Part of that was a lack of nuance or an over-exuberance, if you will, when valuing the tech companies that were coming on board. So companies that had anything to do with the internet or anything to do with technology, as I mentioned, were receiving these astronomical valuations, in part because the financial markets didn't really know how to value them. So instead of valuing companies as we typically do by looking at earnings and profits and free cash flows, they started, a lot of these companies didn't have that. Because they're growth companies, because they were startups, they were just coming onto the market. there was no way to use those traditional metrics in order to value them. And so we started coming up with, or the industry started coming up with, all these new and innovative ways to try and allocate a value to these organizations. So what were those valuation metrics? We talk about things like price to sales, price to clicks, price to views, price to any number of different metrics that would specifically relate to some underlying statistic that that particular company would have. And what ends up happening with that is it becomes a very, those are not solid baseline metrics, and they do not belie the true financial strength of the, or weakness of the company that is being valued. And so you had a lot of companies that were valued on the basis of essentially nothing. And then when the market got pricked, those companies were the ones who fell the fastest. I'm thinking of companies like pets.com, for example. It was, the notion that you were going to buy and sell pets over the internet was something that obviously never really took hold. But anyway, I'll throw it back to you, Dad. So tell us a little bit about what ended up pricking that market eventually at the end of 2000, or the beginning of March of 2000.
Before I get to that, just going back to the Warren Buffett illustration. So Berkshire Hathaway from this beginning of 1999 until early 2000 declined by about 70%. Meanwhile, the U.S. market went up by about 20-odd%. So the difference from in the last 2 years of the 1990s, the difference in performance between Berkshire and the S&P was 60%, with the S&P up 48 and Berkshire down about 11. So very, very tumultuous. Now, the thing that I recall that caused the pricking of that bubble were twofold. One, interest rate, the central bank interest rate started to go up again in late 1999 and early 2000. The other thing that we didn't mention is leading up into in the final 2 years of 1999 was also the whole Y2K phenomenon. Mm-hmm. So this is when a lot of people were concerned that the fact that computers are not going to recognize the change of the millennia going from 1999 to 2000s and confuse computers, and airplanes were going to fall out of the sky and elevators were going to crash to the ground in office buildings. People were scared. Everyone's buying new computers. Everyone's updating their software, and that contributed to the run-up in the valuations for some software companies in that period, not the least of which was Microsoft. So a lot of companies, including hardware companies, benefited from that whole rebuild of infrastructure or technological infrastructure in the late 1990s. And so all that contributed to the excess valuations. But what happened in early 2000 is the United States government decided to investigate Microsoft for
antitrust.
Antitrust practices. And that essentially was the bell being rung for the end of the dot-com bubble. And the market started to decline with that announcement and ended up going down in the early 1990s over a very long period of almost
early
3
2000s,
years.
you mean?
Sorry, early 2000s by about 55%. But then there was other contributing factors. So we had corporate malfeasance in Enron and WorldCom, both being caught with accounting scandals, which also brought down one of the globe's biggest accounting firms, Arthur Andersen, where they fudged their books and did not report accurately what their profits were. They were hiding money. And this, coupled with the 9/11 and an economic recession that hit, all of this brought down the stock market very gradually over a 3-year period by about 50.5%, which was extraordinarily difficult to endure. Having meetings with clients. Now, mind you, our clients were never 100% invested in the stock market. They were in typically balanced portfolios, so the impact on them was probably half as much. But nonetheless, it's still a significant decline in value, and it's very difficult for people to psychologically tolerate it.
Yeah,
and in fact, over the decade of the first 10 years of the new millennia, if you had invested $100 in the American stock market on Jan 1, 2000, by the end of that decade, you would still have had $100, and that's how bad the first decade of 2000s were for the market overall.
Yeah, and one thing just to add to that in terms of causes, as we briefly touched upon, there was the raising of interest rates under Alan Greenspan at that time, which started to erode the value of some of these companies. The other thing that happened that doesn't get discussed very much was when you have these growth companies, these startups, a lot of times when they go public, it is an opportunity for the owners or the creators of the company to get their money out, to basically capitalize or crystallize, I should say is a better term, a portion of the equity that they have tied up in the organization. Now, what ends up happening though is when you go public, a lot of time the key stakeholders have a lockup period in which they are not allowed to exit their positions for a period of time. So usually it's about a 6-month period after the initial public offering. What some people did, and one of them was Sir John Templeton, a famous investor who was the founder of Templeton, and which later became Franklin Templeton Investments, ended up shorting many of the dot-com stocks at the peak of the bubble during what he called temporary insanity and a once-in-a-lifetime opportunity. And he shorted stocks just before the expiration of the lockup periods, and which were generally, as I mentioned, 6 months after the initial public offerings or IPOs. And so he correctly anticipated many dot-com company executives were going to sell their shares as soon as they could, and the large-scale selling would force the prices downwards. And so that's exactly what ended up happening, is a lot of these companies, in addition to the fact that they didn't actually have any real earnings to substantiate their valuations, as well as the other factors that we mentioned, put a lot of downward pressure on their stock price. And so we had this precipitous drop in the stock market for a lot of these companies who didn't have the value to be able to sustain the prices that they were trading at, and at the same time were going to be negatively affected by those other economic factors. So
Just to elaborate a little bit further, and to continue the story of Warren Buffett, as I mentioned, in the late 1990s, people were looking down upon Warren Buffett and his age and his underperformance for an extended period of over 2 years. But once the bubble was pricked and technology stocks began to collapse, and by the way, I think the NASDAQ was down peak to trough roughly 75% or so. It was a huge collapse. In some cases, 90%, and many companies went bankrupt. But during that ensuing period from March of 2000 for the next 2 years, Berkshire Hathaway actually went up 75%, while the S&P dropped 14.5%, the difference there of 90%. So all of a sudden, people realized perhaps Warren Buffett wasn't so stupid after all. And through the entirety of the period, from the last 2 years of 1990s to the first 2 years of the 2000s, the Berkshire Hathaway stock had no correlation or very little correlation with the stock market. It zigged when the stock market zagged, but the end of that 4-year period, Berkshire was ahead 56%, while the S&P was ahead only 26%, for a difference of roughly 30% in Warren Buffett's favor. So sometimes you just have to, I shouldn't say sometimes, at all times, you need to understand what you're investing in. Don't just go by what numbers you hear of late and allow yourself to be influenced. You need to understand what it is you're investing in and make sure that it's of high quality.
to give further context to that, the NASDAQ from 1995 to March of 2000 had risen 800%. And then it subsequently gave back almost all of that return. It dropped 740% from that, of the value that it had created from 1995. It gave almost the entirety of that back in the following correction. And so it just goes to show, and it speaks to what we mention a lot of times to both clients and prospects, which is you can't go chasing rainbows. You know, everybody wants to chase whatever the hot stock is. You have to have a well-constructed portfolio that is well thought out and invested in companies that are viable businesses and in industries which are going to have stable and long-term demand, as opposed to just chasing whatever the latest trend may be. And so with that, I think I'm just going to transition it to our last topic, which is the global financial crisis, which occurred in the late 2000s, as I mentioned, the 2007 to 2009 period. And but in the lead up to that, Dad, so as a result of of what happened with the dot-com bubble, if I'm not mistaken, we had another series of cuts in the interest rates.
Yes.
Which then created another bubble, but this time the bubble was created in the housing market. And with that, I'll pass it back to you.
Thank you, Alexander. So, as you noted, interest rates were being increased in the late 90s, early 2000s. Once the economy fell into recession and it persisted, the central bank was forced to aggressively cut interest rates again. This time they went far deeper and ended up going all the way down to a 1% central bank rate. And when you do that, it encourages people to borrow money. And this time people borrowed money and started buying housing. Now, this wasn't unique to the United States. It was happening here in Canada as well, but it was happening throughout the world when we get low interest rates. So you had a buildup of housing prices throughout the middle part of the 2000s and into 2007. Interest rates were initially set at 1%, but they were about to come due and for rollover in 2007, 2008. And that's when the trouble began. Now, if you recall, we were on vacation in San Diego in 2005, which was about, we're about 3 years removed from the bottom of the market. The market had been recovering quite nicely. And we were in La Jolla, which is probably the nicest, one of the nicest places in the United States. It's a suburb just to the north of San Diego. And I was walking around admiring all the beautiful real estate. And just out of curiosity, I decided to go into a real estate office. So the office was empty except for a sole receptionist, and beautiful offices, by the way, very well decorated. And I asked the receptionist, I said, so what do houses go for around here in this neighborhood? Not knowing how silly I probably sounded to her, since I wasn't a local and didn't have a grasp of what was going on in San Diego. And she says, oh, here's our listing book. And this book was the size of what people used to call the telephone books. It was about 2 inches tall, and it was done in color. It was very beautiful. I started flipping pages, and this is, keep in mind, 2005. So we're talking about nearly 20 years ago. So flipping pages, and I'm looking at house prices, 10 million, 12 million, 15 million, 25 million. And my hair, that's when my hair started to fall out, by the way. I couldn't believe it. And not wanting to sound out of place and foolish, I said, so do you provide financing? And her response was, oh, yes, we'll provide you financing. In fact, we'll finance you 110% of the market value of the house so you can buy furniture. And that's when my head rolled off my shoulders and onto the floor. And I couldn't believe what she just said, because coming from Canada, where you needed a certain down payment and you had to meet a lot of financial requirements up front, to I can walk in off the street, pick a house, get 110% financing so I can decorate it, and then pay for it with a 1% mortgage rate, which was like, in essence, a 99-year amortization with the just you're essentially paying all your payments are to capital, and there's virtually no interest. And at that point, I should have been very suspicious of what was unfolding. Unfortunately, I didn't clue in immediately. And a couple of years later, we reached a peak with the housing valuations. Meanwhile, this new methodology of financing had developed called securitization, where companies that initiated the debt or the mortgages would then package them up and resell them to third parties for the cash flow that the mortgages generated. And that released their balance sheet to lend out more money. And this was going on and on and on. And a bunch of companies got involved in this business, including Bear Stearns and Lehman Brothers and a bunch of other large mortgage companies. There's one really big one I forget the name of, but anyway, they all got their hands on these securitized loans, and they were using them as collateral to lend and lend and lend. So we had a liquidity bubble.
So
brewing.
just to put a name to that, those are called collateralized debt obligations, and the ones that are specifically used using housing instruments or mortgages are called mortgage-backed securities, MBS. And that cross-selling of those securitized positions, those securitized mortgages, is what created the interconnected web that ultimately led to a significant, I don't want to call it collapse, but pretty close to collapse in the financial system. Or we'll call it a freezing of liquidity during
That's
the
a collapse.
Yeah.
That's a collapse.
I was going to say,
Yes.
I'm just going to jump in here and listen to you guys. I
This
would
is-
call it a collapse. Okay.
Yeah. So if this
I was
is
trying to soften the blow. All right.
Yeah, no.
This is the equivalent
The
of
pictures of people being let out of Goldman Sachs who didn't have work, and people being let out of Lehman who had no longer had a desk.
Surreal.
So illiquidity in the financial system is the equivalent of no oil left in your engine. Your engine just stops turning.
Well said.
And so this was a debacle, and this brings us to and how it was affecting me at the time and our clients. And in the late 2007, we were having meetings with portfolio managers with various large mutual fund companies, and one of them commented, the thing that keeps me up at night is these futures contracts and option contracts and securitized mortgages, and we're not sure how they're being valued. And but in spite of that, they too didn't see what was about to unfold in the following year. And 2008 did not begin well, but it accelerated very rapidly after the spring. And here in Canada, our market held up much longer because we were principally resource-based economy, and oil prices started to go up. And so our stock market was spared the initial impact. But once it hit the fan in September, October, then everything went down together.
Let's pause that and just explain how it hit the fan specifically. So we've established that we have the interconnection of all these financial institutions because they have packaged together all these mortgages for these homes that people can ill afford. And they have packaged them together and sold them in exchange for the cash flows, as you've mentioned, from those mortgages. But what ended up happening was as rates started to go up and renewals started to come due, people couldn't afford these mortgages that they were paying. And so they started to default. And so when you start to default on the mortgage, what ends up happening? Well, there's no more cash flows. Well, if there's no more cash flows, then the company who's purchased these mortgage-backed securities is not getting any cash. If they don't get any cash, they have no cash to then turn around and lend out to other borrowers. And so you had this snowballing effect because it was happening everywhere across the financial markets, where all these institutions were left holding the bag for all these mortgages that were of low quality. Part of the blame lays with the credit rating institutions who didn't properly value and assess the risk of these assets. I see Bill nodding vigorously over there.
Vigorously agreeing. I mean, what made it even worse, John and Alex, is that these loans were mixed in with other solid loans. Yep. So there were a lot of these debt instruments that were sown with bad seed in the middle of the portfolio, so that people didn't know. Yeah. And so it would have been easy if you'd have, that's a bad portfolio. Don't buy that debt instrument. That wasn't that easy. It was sewn together with other good mortgages. Yeah. And that's what made this whole thing so much more complicated, and why I say, like I had to jump in and say earlier, it was a collapse because it was disastrous.
It's like money laundering. Like you've layered in the good money with the bad. And so it becomes very difficult to discern, as you mentioned, which are the good loans and which ones are the bad ones, or which ones are the high quality instruments, because they get rated, from AAA all the way down to junk status. And if you're interweaving low quality loans in with the AAA rated assets, and you still slap a label on them and say it's AAA, well, that's not true. And so you've priced them according to the fact that they're very low risk, but in reality, there's a lot more risk than the price would suggest, and so they're overpriced. And anyway, that led to a subsequent decline in the financial markets, a collapse, as you mentioned, and the result of which was several institutions ended up going bankrupt. Most notably, the Lehman Brothers institution was allowed to go bankrupt, while Bear Stearns was bailed out by the central bank, and a number of other institutions who failed were purchased and bought out by other organizations. Merrill Lynch, for example, was bought out by Bank of America, if I'm not mistaken.
Right. Yep.
Who
underwent a period of uncertainty for a while because of the mortgage, because of the debt security packages that were in all of the portfolios. And if you'll remember, regulators were like, we got to sort all of this out. And so Bank of America's valuation in the market suffered for a long time after buying Merrill Lynch.
to get back to these investment banks that collapsed under the weight of this scandal, you had Hank Paulson, who was I think the Secretary of the Treasury back during that period, but he was a former Goldman Sachs Wall Street banker. And so why is it Lehman Brothers was allowed to collapse and Bear Stearns was allowed to be purchased by JP Morgan at a dramatic discount? So you had personalities from Wall Street perhaps getting vindication or getting competitive with one another and allowing a company that was still viable to completely freeze up. So that was arbitrary and subjective as selecting which company was going to be allowed to fail. But inevitably, they had to step in to do something, and they did provide the liquidity that the financial markets required, and interest rates, after being raised from 1% at the depth of the early 2000s dot-com bubble collapse, they had fallen 1%, but from roughly 2002 to 2007, interest rates started to gradually come back up. And by 2007, they were coming up to, I don't have the number in front of me, but say 5%. So mortgages that were initially at 1% had to be renewed at 5%, and people couldn't afford to renew at 5%. And that's what that raising of interest rates in 2007 contributed to the pricking of the second bubble, being the housing bubble, in the first decade of the millennia. So once again, the central bank had its fingerprints all over the body, and the central bank was created in 1913 by an act of government, and
the current iteration of the central bank. This is, I believe, the third or fourth.
The third. This is the third iteration of the Central Bank of the United States. It has its fingerprints on every recession and depression from 1913 to the present, including the Great Depression of the 1930s. And we'll cover that topic in a future podcast.
Pay attention to the policies and actions of the central bank is a central theme that runs through the last two episodes. That's fair to say, don't you think, John?
It is very fair to say, Bill. The other thing I want to mention, and you and I being of a similar generation, we grew up at a time when there was a Cold War going on between the West and the Soviet Union. And the argument that was made in the West was that you have to function as a free market. And the irony was, while we operate as a free market with respect to companies, fiscal policy was by order of government, and therefore you had to have representatives choose it. But monetary policy has always been contained to a group of 12 to 13 individuals that meet behind closed doors and decide when to increase and decrease the supply of money, which has dramatic impacts on economic activity. And the argument we had against the Soviet Union is you cannot have centrally coordinated policy, economic policy, provide stability to an economic system. So we're speaking out of both sides of our mouth in the West, saying you can't do it this way, but we're going to do it this way, but in a different way on this side. And so it is the central banking system has demonstrated over 100 years how it was failed to reduce the number of economic cycles, which was the original ambition. And we've had all these different crises over time. With that, I'll give it back to Alexander.
Yeah, and so basically, to sum that up or to summarize, it's a result of the difficulty. Instead of allowing market forces to determine the correct time to for the market to fluctuate, we have individuals who are trying to internalize and interpret and artificially maneuver the market. And the problem is the exact timing of which is virtually impossible for any one person to accurately predict or determine. And so what ends up happening is the getting involved in the fluctuations of the market ends up creating exaggerated waves, and we end up creating more cycles. And so what ended up happening following the great financial crisis in 2007, 2009 was we had rates cut again to near zero. And so when rates get cut, obviously we know that that positively impacts the stock market and the economy. And so we'll pause that there. We're going to pick that up in the next episode, where we're going to discuss exactly how that unfolded.
Alexander, sorry to interrupt before we close off this episode. I just want to finalize some things that happened in that waterfall collapse in 2008. And the market did not go down all in one fell swoop by 55%. It fell in waves. In the first wave, from November of 2007 to July of 2008, was about minus 20%. There was a bit of a recovery, but then it fell in a second wave from September to the middle of October by another 35%. Again, a little bit of a bounce, and then it fell again into March of 2009. Now, what was really interesting is on October 6th, 2008, specifically, the market was in free fall that day. And I knew my clients were going to be very upset. So I walked into a recording studio with a loosely prepared historical data from the 1990-1991 savings and loan crisis. And I started reading off media headlines of that time period from 1990-91, and they eerily sounded like the media headlines of 2008. So I started reading these off and recording. And at the end, I said, these headlines I just read to you are from almost 20 years ago, from 1990-91. So this is not new. This has happened before. We're going to get a recovery eventually. What you don't want to do right now is be selling into a waterfall decline. If you have money to invest, now is a good time to begin adding to your position. But you definitely don't want to sell out. And you want to change. If you're withdrawing money and you're retired, you want to try and reduce the amount of withdrawals as much as you can tolerate temporarily until we get our rebound. And that recording spawned a series of 10 annual recordings I did on October 6th, demonstrating over the course of the following decade how that dramatic event eventually became history, and we recovered completely from it.
Mm-hmm. And reached new highs in the stock markets in the subsequent decade. But that's a story for the next episode. And as we've mentioned, we've covered a lot of history here from the mid 1990s, starting in 1994 through to the end of the 2000s, 2009. And so when we pick back up next week, or our next episode, I should say, we're going to start with the European debt crisis and how the fallout from the financial crisis impacted the markets. And so with that, I'm going to turn it back over to you, Bill.
Yeah, guys, it is useful to remember as an investor, and it is important for financial advisors, I think, to do what you're doing, which is to remind people investments long-term are terrific things, but long-term denies the look at short-term corrections that inevitably and always do happen. And, and I would imagine, as sitting in your chair, it's a little uncomfortable when you have to look at clients and go, yeah, we know this is a tough period and it's down 15%, but, if you stay with this, historically, you're going to be fine, which sounds like cold advice, but it's true advice, right?
Mm-hmm.
Yeah.
Sometimes you have to be a little bit dispassionate.
Well, we've been doing a lot of hand-holding, and studies done by a Boston-based firm, Dalbar, have indicated that the psychological biases that affect individuals' decision-making when it comes to money results in roughly a 3.5% difference between the realized results of individual investors and those of their underlying mutual fund portfolios. Wow. So that is a significant price to pay. And so yes. There is a significant value to dealing with, as Alexander said, a dispassionate third party who can put things into context and perspective, so you don't make wrong decisions at the wrong time.
It's hard. I mean, look, I'm an investor too. I look at my portfolio just like you do and like everybody else does, and it's like, oh.
Well, it's the most difficult thing to do is not to act, because yes. 3 years ago, I transitioned away from a financial intermediary into a portfolio manager role, and now having full control of when to trade securities for a large group of clients simultaneously. Yeah. I have a tremendous ability to impact gains and losses through decisions I make. And there are many times when there is a temptation to execute a transaction due to short-term circumstances. Yep. And it takes all my years of experience to at times hold me back and say, no, this is not the right thing to do at this time. This is not our process. The process says to leave it alone, and so we're going to leave it alone. And it is very difficult to do. Sometimes to do nothing is often the most difficult thing to do.
Amen. Amen. Sometimes there is a time just to push the chair away from the computer and stand up and walk away. I do hear you. This is a good conversation as always. Guys, I don't want to leave without getting your information out there. If anybody's listening to this and wants to get in touch with you, have further conversations, how do they do it?
Yeah, absolutely, Bill. They can reach us at info@medwealth.ca. That's info@med-wealth.ca. You can also visit our website, which is www.medwealth.ca, or johnsoutsos.com. And we are on Twitter and LinkedIn, and they can also reach us by phone. All that information is available on our website.
Fantastic. Thank you very much. Listeners, thank you for taking the time to listen to this. We hope you found it useful, instructive, and maybe even a little calming to know that we've been there, done that many, many, many times before, and you should probably remember that before you decide there's something you need to do, as a matter of fact. The one thing you don't need to wait to do is hit the subscribe button. If you're not a subscriber already, please hit it. That way you do not have to remember when or where you heard this podcast or when it comes out again, because it will be delivered to your listening device. You'll be notified and you won't miss another episode. Thank you so much for listening. On behalf of John and Alex and everybody at MedWealth, I want to thank you for listening. I'm Bill Tucker, reminding you, do not wait. Live your best life today. Thank you.
Thank you for listening to Prescribing Prosperity. Visit our website at med-wealth.ca. That's med-wealth.ca for more information or to connect with us for a consultation. Don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the hosts and their guests and does not necessarily represent the views or opinions of IPC Securities Corporation. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investment advice. Always seek the advice of a qualified and licensed financial service provider with any questions you may have regarding your investment or retirement planning. MedWealth Financial Services can provide a private consultation to help you determine the suitability of any guidance discussed on the show.